All right, everybody. Hey, I want to welcome everyone to Capital Gains Tax Solutions Deferred Sales Trust Mastermind, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options, not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is an amazing way for you to exit highly appreciated assets, defer hundreds of thousands to millions of tax, remove funds outside your taxable estate so you can create and preserve more wealth, or help your clients, friends, and family do the same. For those who don't know me, my name is Brett Swartz, and I'm the founder of Capital Gains Tax Solutions, and we're on a mission to help a lot of people out. By the way, coming out with the book here shortly with Kevin Harrington from Shark Tank, and also an author who's here today. He's here every week as well, but he'll be in the book. And we're going to be talking about deal close story of the week, as we do every day, every Friday at the same time, as well as kind of the vision of why we're here, and then kind of open up for discussion or come up, challenges or frequently asked questions for anyone out there looking at doing the Deferred Sales Trust. That being said, I am joined by the man that met the legend, Jake Miller, financial advisor, CFP extraordinaire, all kinds of other things. Jake, how you doing today?
Doing well, Brett. Happy to be here, and is an exciting time. I'm looking forward to the deal close story of the week. As well as many other things. I know that there's some people here in the audience today that have questions for us, and it's an exciting time because this is a very flexible financial tool, the Deferred Sales Trust, that allows us to help solve a lot of people's problems. And when I say problems, we're talking about tax scenarios, capital gains, and how they can possibly reinvest that money rather than paying it to the government right now.
Absolutely. And then we also have Pierce in the house as well. He is the co-host with me with Capital Gains Tax Solutions podcast and a part of the team, a luxury real estate agent as well, with the EXP team that we have down in Newport Beach. Pierce, how are we doing today?
Doing amazing. How are you guys?
Doing well. Pierce, who does the Deferred Sales Trust work for?
Anybody who's selling a highly appreciated asset with at least $1 million gain and $1 million net proceeds into the trust, unless you have two transactions for about $500,000 or more that can, or if you have a $1 billion and you want to test it, you can do that too.
You want to test it on a smaller deal. And Pierce, we have a live deal, you and me, with your father-in-law, right, who's selling, and talk about that deal that's closing, and then the next one as well that we're working on.
Yeah, so my father-in-law purchased this mountain house a few years ago from a friend, and he bought it for $1.25 million. He put about $100,000 into it, and then had like a retaining wall fall down that he's had to put a little bit more capital into. But after you depreciate it for 4 years, 3-4 years, that kind of washed it out. We're selling it for $1.85 million. And it's pretty much the buyer's taking care of all fees, including the realtor fees and all that kind of stuff. So there's about a $600,000 capital gain roughly. So about $220,000 tax liability given his tax bracket. So we're going to plop it into the DST, and when some other business ventures or real estate opportunities pop up, we'll be able to have some liquidity to jump on those.
Absolutely. So he's a long-time real estate investor, and Jake Miller with the financial advisor here, and a long-time investor who wants to get some freedom, some flexibility, taking advantage of the higher price market. Pierce, what was his biggest concern or objection, learning about this? Because I know it's been a couple of years since we've been talking with him and kind of going through it. But what was it, and how did you help him get more comfortable with the Deferred Sales Trust?
Besides, him not loving me that much because I married his daughter. That was the biggest one. Still trying to earn that love. No,
but you overcame it, right? When you had the grandbabies, right? The grandbabiys is what gets you in the good spot.
The grandbabies are the only reason he puts up with me. No, it's just it honestly, the biggest thing for him was literally just getting him to sit down and talk about it for a little bit, because he's so sporadic and just very he'll just you'll be talking to him, and 1 second you'll turn around, and then he'll be gone. And it's like, so it was like really trying to nail him down to talking. And the best way to do that was to start involving Brett and Jake and the other people who are more than just, his son-in-law at this point, right? And because how did you figure this out? Like, I got billionaire friends who don't even know about this. Like, what? Like, how did you? I'm like, it's not just me. Like, here's the all-star team. I just got lucky.
That's a great point, right? I mean, it's a great point. It's a team effort here, right? And even myself and a lot of folks that come and find us, they're many years wiser and many millions more net worth, and they're saying, how do I not know, and how have I not heard about this before? And that's where we say, well, we'll come meet the team, right? And come talk to our references and our clients and the banks and the qualified intermediaries and the financial advisors and everything that we have to help you with that. So I think that's a good thought there, Pierce, that don't go at it alone, right? And sometimes even if you have some of the answers, it's good just to bring folks to a master class like this or mastermind like this. Bring them on a call with us so that they get a chance to hear it from folks that we're literally doing it every day. And as a part of that, the analogy Jake Miller I like to use is, we got these Rubik's Cubes, and every day people are showing up to us with these different challenges, and they want to try to get these Rubik's Cubes to be as maximized and as congruent as possible, right? With tax flow, with cash flow, with some of their needs, Jake, when it comes to lifestyle, when it comes to their entrepreneurial freedom, when it comes to exiting cryptocurrency at a very high to not have to suffer some of the consequences of the low. We're learning that lesson right now with a lot of folks. So, but Jake, anything else to add to the vision or the kind of the value of the deferred sales trust?
Absolutely. At the end of the day, everybody's situation is different. The wonderful thing about what we have going on here is we have different professionals that can sit in. It's kind of like a basketball game. You've got 5 people that are on the court at once. There might be more on the team. You might pull people off and put people in as needed. And, the trustee is kind of like the coach. He knows when and how other people need to be brought to the table to help solve the client's problem. And that's kind of like the Rubik's Cube analogy that you're talking about, Brett. You might turn it a few times to try and get some of the colors matched up and pass it over to me. I might turn it a few times. We pass it over to the tax attorney. He might turn it a few times. Eventually ends up in the client's hands, and it's perfect. And it's done. It's matched up for their scenario, their situation, what they need so that they can accomplish their goals and objectives, defer the capital gains now, reinvest it, grow their overall net worth, and at the end of the day, accomplish what they set out to do.
Absolutely. Sorry about the music there. And so I wrote down, like, this week I got some coaching training too by a guy named Coach Burt. And if anyone heard of Coach Burt, he's incredible. And they call him America's Coach. And he was talking about ways to help people overcome, false beliefs of different challenges or different things. And it's about making what he calls belief statements and or like what we know to be true when it comes to what we're trying to do. So with the capital gains tax solutions, with the deferred sales trust, they did a couple of them. I'm going to share them live for the first time here. And it's also part of the vision and why we're here and part of our values. And so part of this is with capital gains tax solutions, what we're doing is we believe every client we work with deserves an exit plan that does some of the following. Number one, allows them to escape feeling trapped by capital gains tax and the strict 1031 timeline. And that 1031 timeline often creates a situation of overpaying for a property or taking on more debt than they want to. Number two, allows them to have their equity liquid and diversified into investments, which can help them preserve their wealth, especially in times of change like this. Number three, they deserve an exit plan that does the following. It allows them to live a lifestyle of their choice. That might be passive lifestyle by retiring and getting passive cash flow off the trust and kind of retiring from the day-to-day operations of a business venture or real estate, investments. Or they have the chance to be active by partnering with the deferred sales trust to be an entrepreneur and or to be an active real estate investor. And I believe there's also 3 main things that the deferred sales trust, it really makes the deferred sales trust different. Number one is optimal timing. And optimal timing gives you the ability to invest with the deferred sales trust or have the deferred sales trust invest on your behalf, right? At any time, dollar cost averaging into stocks, bonds, mutual funds, cryptocurrency, real estate, ground up development. It's got to be business purpose, but really taking the idea of sound fundamental wealth creation and preservation, which is dollar cost averaging, and investing when the time makes sense for you into assets that make sense for you. Number two, is control. Okay, one of the biggest things with the deferred sales trust we hear is, I'm giving up all my control. Well, it's not true. In fact, nothing moves without your approval, and this is why the deferred sales trust is different, or your signature. And this includes all investments and all movement of funds. You are the secured lender, and everything must be approved by you. Number three, and why the deferred sales trust is different. It has to do with asset protection and estate tax solutions, okay? In fact, you can eliminate 40% of the death tax or estate tax by removing funds outside your taxable estate using the deferred sales trust. We call it 2.0. It's also known as the DST Plus. And the other part about that is you don't have to give it all the way to charity. You don't have to gift it to, 10 kids, and you don't have to buy a bunch of life insurance. In fact, you can just do it in one transaction and one sale. It does take a sale, third-party sale, and it has to happen before you pass away. That's the key to get it outside your taxable estate. And the last part of that asset protection is it can protect the equity from creditors, because the characteristic of the trust is that you are a lender. You're not the owner of the trust, because if you were the owner of the trust, it'd be taxable. But the fact that you are the lender means that somebody can't attack what you don't own. Okay, so it's this beautiful way that creates this asset protection. Now, could that creditor receive, or should a judgment come? Could they receive the cash flow off of the trust? Yeah, they could get access to that depending on the whatever that it comes down. But they can't attack and get the corpus of the trust. So, Jake, any thoughts on all of that? I know that's a mouthful, but I'm working through some of these things, the beliefs and what makes the deferred sales trust different.
I think it's incredibly important because sometimes clients get confused. They might be getting advice from a lot of different people. And it's always best if we can get all the clients' advisors, so to speak, that have an influence on what their final decision is going to be to the table at one time. And it just saves everybody a lot of effort and a lot of repeat. We had some clients that we explained it to one of the clients, then they brought in a partner. Then we explained it to the partner. And, they were skeptical at first, then they loved it, then they were all in. And by the time we explained it to the second partner, the first partner was like double in. And then we had to explain it to their attorney, who was a junior attorney, who really didn't get it. And then he had to bring in the senior attorney. And so now we're like 4 times in, and the first partner is like triple sold, and the second partner is like double sold, and the junior partner is finally starting to get it. And then the senior partner, like from the very beginning, is like, oh, okay, that makes perfect sense. But you know what? We're actually not providing this service to the client. And they had to bring in another attorney. And it's like, oh my goodness, so literally, this is very important because a lot of the topics you brought up, Brett, are common things that clients get confused with what we do. And there may be a right point in time to do some of those other strategies. But what we found time and time again, that this becomes more of the keystone strategy that they do first. And then with maybe a chunk later on, when the timing is right, they might do that charitable remainder trust. But instead of $10 million, they're going to do it with $1 million, because that's actually what accomplishes their goal and objective. So sometimes some of these other strategies that you brought up, Brett, are oversold and overused to accomplish more than they should. And at the end of the day, the client ends up later on being unsatisfied because they had to put more money into it than they thought they needed to. They had to accept more debt than they really wanted. They had to, it was inflexible. Now it's an illiquid investment and they don't have access to it. Whereas if they had began with a deferred sales trust with proper planning, 20 to 30 days or 2 to 3 months, even better, prior to the transaction, get into these discussions, bring all the relevant people to the table, and let's make sure that we're accomplishing the client's goals and objectives. And there's going to be a right way to do it. And 99% of the time of the clients that we talk to, it involves the deferred sales trust being the keystone product amongst all the other products.
Yeah, I couldn't agree with you more, Jake. And that's why we're so passionate about what we do, and we're so niche and focused on what we do with the deferred sales trust. We don't do 1031 exchange services. We refer that out. We don't do charitable arrangement trust. We refer that out, and we just focus like a niche on executing this. And we do believe that in the vast majority of circumstances, with the flexibility, with the tax deferral, most importantly, the legal background, right? 26 years, thousands of closes, billions under management, over a dozen no change IRS audits, also additional formal audits on top of that, all no change, no findings, batting 1,000, lifetime audit defense built in. You can feel really good at night knowing that it has a perfect track record in all 50 states. And when you think of it, dental practices, veterinarians, business sales, car dealerships, car washes, apartment complexes, public and private stock, cryptocurrency. We just did a land sale. In fact, that's the deal close story of the week. Although we talked about Pierce's live deal of the week, I guess we could always do a end escrow and then we could do one that's actually closed. And so the one that actually closed last week, Texas land sale. I want you to go 48 miles south of Austin and a little bit east of San Antonio. And it's this really small town. I think it's called like Ludwig, something like that. I don't even really know the name. I've never been there. And I met the client about a month ago. He flew into Napa, and now he's Jake and I's client with the Deferred Sales Trust. And he's in the business of buying land and then turning around and flipping the land. So it's a quick sale. So basically, they tie up land and they do some improvements. They might get it entitled. They might do something else. They might even just buy it at a discount. And then they find a ultimate buyer to buy it, and then that delta is their tax, right? Or is their gain, which they're going to get taxed on. And say they were able to tie the land up, work through the processes, add the value, but a simultaneous close, they moved their proceeds into the trust, and the seller got what he was accounting for, the buyer got what he was accounting for, and they were able to not have to incur all of the tax. They were able to defer it. And so the sale was approximately $5.85 million, and they put a large majority of that into the trust. So a very successful opportunity for them to not have to take it as ordinary income tax as well, because the deferred sales trust does work for short term and long term, whereas a 1031 exchange only works for long term. And they have multiple deals they do every single year. Of course, they said they wish they would have found us earlier, but now moving forward, they're doing all their deals. In fact, Jake and I will be flying to Cabo to present to some of their inner circle investors coming up. But Jake, any thoughts on that deal?
Yeah, so I kind of want to talk a little bit. Somebody was asking me about referrals. How do we send somebody to you guys? Well, easily enough, you just introduce us, right? I mean, that's easy. But maybe you can touch on that, Brett. When somebody wants to let their best friend, their business partner, their colleague, one of their clients, because we get a lot of referrals from CPAs and such, right? And you get a lot of referrals from real estate agents. How do you tell them to tee it up?
Yeah, I mean, the key is just if they have the problem, right? And the problem is the tax, and it's capital gains tax, and it's typically somewhere between 25 and 50% of the gain. And so just say, yeah, it looks like you have a tax problem. Well, guess what? We work with Strategic Tax Solutions, is Jake's firm, and we work with Capital Gains Tax Solutions. This is what they focus on. So here's an email, here's a text message, have them give us a call. Right. If it's your direct client, it's even better, direct relationship. So it's simply going to our website and scheduling a time. You can also invite them to this masterclass, this mastermind. I think this is also a good opportunity to get a feel for Jake and I and our team and Pierce and be able to absorb a little bit about what we're about and what we're doing. So Jake, hopefully that answers the question pretty good?
It does. And again, it's just, some people hear about this, or some of our clients that we've brought in and they've had a wonderful experience. I mean, one of the best ways for them also is to just tell their story. It's like, hey, a lot of people were trying to sell me something, but Brett and Jake and Pierce and everybody, they actually provided me with a solution, and it answered all of my big questions.
Exactly.
And again, telling somebody's personal story, either they're not inventing anything, they're just being honest, and they may not know all the right words to say, but just share that it was a very positive outcome, that they had a good experience, and that they got the gross proceeds of the transaction to reinvest rather than just, the net proceeds after taxes.
Yeah, honestly, I think the deferred sales trust sells itself. Like once you look at the math, and I always say that, it's like the Mike Tyson quote, everyone's a skeptic until they get, everyone has a plan until they get hit in the mouth, right? And Mike Tyson would go into all these fights and all these knockouts, and they have these big talking, and he'd always just say the same quote. Anyways, everyone's a skeptic until they're about to hit like millions of dollars of tax. And then the key is jumping in with our team, getting comfortable, hearing client testimonials, and then seeing the legal track record and get your answers to your questions. And that means also, by the way, bringing in your trusted professionals, right? Bring in we have a financial advisor, Jake, but bring in your CPA, bring in your commercial real estate broker, bring in whoever it is that's been helping you with building your wealth, and have them ask the tough questions of us too. Honestly, 9 out of 10 all join us and send us referrals too, and it all works out. That being said, we're ready to open it up for frequently asked questions and or live deals. And so if you have a live deal, if you have any questions or comments, you're welcome to put it in the chat. You're also welcome to unmute yourself and ask away for Jake, myself, and or Pierce. We're here for you to answer those questions. So who has a question for us?
It's kind of difficult. We're managing the Zoom and we're managing the Facebook, and sometimes questions come via text. And so if you see us looking up, looking down, looking to the side, that's because we're trying to monitor everybody.
Okay. Yeah, and Glenn says he has a lot of background noise. He'll come back next time. No problem. And we'll keep talking, and as questions and thoughts do come up, I can also share my screen. I think there's a common thing here, which I have my iPad now, where we can go through a scenario on how to use the deferred sales trust to partner with you. That's also seems to be a common one here, and that I'm going to create a little Zoom screen share here, and on my iPad, and we'll kind of map this out. See if you can see my screen okay there. Can you see it okay?
It's white.
It's right there. Okay, perfect. So, Jake, let's walk through this. What if someone wants to purchase investment real estate with the trust? Jake, give us kind of the big overview, okay? And then we'll show it on the screen here.
Yeah, so let's talk about the client's previous transaction, which was $6 million. All right? So they have $6 million in the trust. All right? So that deal's been done, and what's next? And they're a serial entrepreneur, serial real estate investor. They found another property. They got a screaming deal. And this is really good because, they sold in California. They got the $6 million in there, and they found this deal in Texas. And this really good screaming deal is only $2 million.
Okay.
So how do they do it, Brett? I mean, they've got $2 million. They got to somehow, the trust needs to participate. They need to participate. They want the depreciation. They want that tax benefit. How much money goes each direction? How does this look? How do they get money out of the trust?
Yeah. So I'll answer the question. So that there's the trust itself. Remember also as well, real quick, it typically owes somewhere between 6 and 8% on it's a promissory note, right? So the trust is holding the $6 million, and what's owed back to you, the client, is this $6 million at 8% on a promissory note.
So this is an expense to the trust.
Yeah, it's an expense to the trust, exactly. And so that is somewhere around 8%. That is $480,000 per year. So it's not guaranteed, and it's not. We got to go make the money. And the question is, well, how do we make that money? Well, we can be in stocks, bonds, mutual funds. It could be in securities. Okay, let's say Jake's put it into some stocks, some bonds, some mutual funds, even insurance. It could be in a number of different things over there, but it can also be back into some real estate. And so let's just hypothetically just say that $4 million is sitting in these liquid investments, diversified, and let's just say that that's making, that on average that 8% over any 10-year period. So that's producing the $320,000. And so now we want to try to get this other $2 million to live up to its job, which is to produce the rest of that 480 minus the 320. So what we're going to do to get there is we're going to form an LLC. Okay, LLC. So Jake, explain why we're forming an LLC and the benefits of that.
The benefits here, an LLC, a limited liability company, is a disregarded entity that can file as a partnership, and it can benefit from those partnership rules, those general partnership rules. Now, the reason we're doing the LLC is this is an outside entity outside of the trust. This allows the trust as a partner to put down the equity. So the trust can now transfer $2 million to this LLC that the trust is a partner in, as well as you, Mr. and Mrs. Client, on the other end. Now, this is incredibly important because if the trust itself were just to go buy that real estate, which it could, right? That might be a method to do this, but not the best method. We do it this way so that you, Mr. and Mrs. Client, under the general partnership rules, you can be benefiting from the depreciation that the trust otherwise would not benefit from. So you can be pulling that tax benefit out. I mean, what is the biggest reason why most investors invest in real estate? Again, we're talking on one end, the income from the doors, right? But by and far, the largest reason that most real estate investors invest in real estate when they have other businesses and other income is 1, diversification, 2, the tax benefits, and then 3, the income. That is the most common order that people invest in real estate for those reasons. Okay.
Excellent. And you do get a brand new depreciation on this property, right? Which, remember, at a 1031 exchange is old. Now you are only going to get 80% of that personally, okay? The trust gets 20% of that. And the reason why is because what we're doing is this LLC partnership is split 80-20. Oh, let's do, this is going to be like this. 80% ownership is you, 20% is the DST. The DST puts up all of the 2 million, you put up 0, but since you're doing the sweat equity, we can structure the deal, and this is the LLC, okay? This is the LLC. We can structure the deal. They're also going to want an 8% pref, the trust is. So this 2 million goes into this LLC, which is split 80%, 20% with an 8% pref on that 2 million that's due. What's a pref? Well, pref is what's known as a preferred return. An easy way to do the math on that would be to take $2 million, times it by 8%. That equals $160,000. So 2 million at 8% equals $160,000 per year. Okay. So this is what it's accruing. So Jake, does that mean I've got to pay it right away or that year, 160? What happens if I'm just buying a multifamily property that is going to be construction or it's going to be a land development deal? Like, does a pref mean I have to pay it right away, or what's the timing on that, Jake?
A pref just means that it's owed, meaning it's first to come out should anything come out.
Exactly right. And which means what, Jake? If I take this $2 million asset and let's just say it goes to $5 million, it's a multifamily property. It goes to $5 million when I go to sell it. And let's just say that I did it in 1 year, to keep it really simple. Did it in 1 year. I mean, it was just an amazing deal. 1 year later, what would happen? How would everything be split between myself as an 80% owner and the trust as a 20% owner?
Absolutely. Great question. So here we have 80-20 at the end of 1 year. What is the growth? We got $3 million in growth. Are we talking total proceeds or the additional gain?
Yeah, let's do the 3 million in growth, and then let's minus out the 8% pref on the 2 million, and then let's back it out so everyone can see it.
Okay, very good. So after 1 year, we've got the 160. We back that out of the 3 million growth, and then we can split that gain between the two partners of the LLC, which one partner is the trust, one partner is you, Mr. and Mrs. Client. So we take the expenses, of course, the pref and what's owed. We subtract that out from the gain to offset because that's an expense against the asset. And then we allocate based on percentages.
Which goes 80-20, right? 80% here to you and 20% back to the DST.
Now, if an individual had just, with their own money, rather than partnering with the trust, went and done this deal and got a $3 million gain at the end of 1 year, that individual would have a much bigger tax ramification than what we're showing you here through everything that we can possibly capture within the trust as part of that. And then, of course, here under this transaction, under your portion that corresponds to you, we can utilize the trust again. So in the very beginning, we established the trust. We had the $6 million sale. We collected the $6 million proceeds. Then we used the trust, the joint venture on another real estate project. And after a year, we've sold it again. All right. And we're going to, you can see these ramifications here of what the taxes would be if the trust weren't around. Now, on the second sale, we're going to bring the trust in, and there's going to be a second promissory note.
Yep.
And you can see that we're chipping away and offsetting part of those gains with the pref, as well as by splitting it with a new LLC. And so we're able to add that back into the trust. And now the trust holds more assets, as well as has two promissory notes. So now, Brett, do you want to maybe reiterate what I just said?
Yeah, absolutely. See, hear it again. Let's also remember what the very beginning, where we came from, right? So we came from this $6 million was in the trust that was owed at 8%, about $480,000 per year, which $4 million went into like a liquid investment grade security, stocks, bonds, mutual funds, insurance, which is producing about $320 a year. Now we want to get to 480 is the goal. And so you found an apartment complex and you decided, do you want it to invest it? By the way, you can get debt on that apartment complex, but we're just going to keep it simple. We're going to say you're going to get no debt, just all, pay cash. And so you're going to form a brand new LLC, which, by the way, you're the majority owner of. In fact, you get 80% ownership. Now, how much money do you have to put into that? Well, zero. And the trust puts up to $2 million and asks for a 20% ownership with an 8% pref. What does that mean? Well, remember, the pref is at 8% per year. It's about $160,000 per year. So it's owed back to the trust. But remember, notice how this 8% is the exact same 8% here. We're going to mirror that. And the goal is to try to take that gap. Notice this 480 minus this 320 is what? 160. Okay. So it's the goal, not a promise, not a guarantee. In fact, your deal may only be a 5 cap or a 4 cap or a 6 cap, but it's going to be a preferred return that's accruing until an exit happens. And when the exit happens, remember it exits at $5 million. There's a $3 million gain there. So how does it get split up? Well, you got to pay the original $2 million back to the DST, which is going to flow. A better way to put it would be to flow it upwards back to the $6 million where it originally came from. But for space-wise, I'm just saying back to the original DST, which is at $6 million. Okay. Plus this preferred return of 160. Remember, because it's been accruing, this is a 1-year sale, 1 year to do this. So that's going to go back to the trust. Now you might be asking, well, do I give up that money, that 20%? Is it? Well, remember, the money, it's owed to you. You're not giving it up. It goes to the DST, which, remember, it owes you this $6 million. So you can think of this $2 million kind of like you borrowed it from the trust. So it's just paying it back, but it's not technically borrowing because that would be taxable. It's actually a joint venture partnership. So the trust gets paid back its original $2 million it put in, plus an extra $160,000, which is the pref, which goes back to paying you on the original $6 million. So you're basically made whole there. But guess what? There's this extra $2.8 million left over after that, which goes what? Goes 80%, 20%. So there's an extra $568 that's going to go into the trust, which you might say, well, Brett, does that $568 just disappear? No. So this trust, remember, this is $400,000 just 1 year. Over 10, it goes into the pie, and the pie is 480 times 10. So this 568 goes into the pie of 480, and then you have an extra 2.272. That could be promissory note number 2. So all the smoke clears, and this is what happens. Okay, you're going to get the original $6 million is going to be back in there, plus this 568, which is going towards paying you about 480 per year. And this is times by 10 years, right? So this is just going back into the pie. Remember, this is having to pay you at 8%. Correct. This is promissory note number 1. Number 1 here, so if I can't hear me there. Now you're going to have promissory note number 2, which was this 2.272 million. Okay. Now this is the cool part, right? So you got 2 promissory notes. Now this is kicking off 8%. And the goal, that's the goal, not a guarantee. And 272, 8%. That's about $217,000 per year, okay? And a total of about 8.272. Jake, any thoughts?
So aggregate that all together for the final piece. And I believe that answers Land's question in the comments. So what we've done is through utilizing net of attorney fees rather than net of taxes, the proceeds from the sales, utilizing the deferred sales trust, which, yes, there's a fee for the trustee, there's a fee for the financial advisor, but we provide for all of this, right? And at the end of the day, in this scenario, now again, this is hypothetical, we used 1 year just to make it easy, right? But we've gone from a $6 million transaction, which normally they'd probably lose 1/3 to 1/2 of that to taxes. We were able to use the gross proceeds minus attorney fees to reinvest in other assets. We used 1/3 of that to reinvest in multifamily in Texas, right? And we have grown those assets from the 6 to the 8.272 and literally used money that you would have otherwise sent to the government to grow the asset.
Yep. And that's somewhere between 25 and 50%. And so on the second transaction from 2 to 5 million, that's a $3 million gain. If it were at 40%, that is an extra 40%. It's an extra $1.2 million. Okay. Which has all been rolled into this one DST, which has 2 promissory notes. They total this 8272.
2 promissory notes from the 2 deals that it's participated in so far.
Yeah, exactly. Any questions from anybody on any of that?
Hey, Brad, it's Rebecca. I'm put some comments in there, and then I forgot we already deleted we took out the 160 originally. So that 568 goes back towards the payments.
Yeah.
To the and it doesn't necessarily. Does it increase the value of that original trust?
No, it doesn't change the promissory note. It's owed to you.
Okay.
But think of it just like accruing interest, right? So Jake over here, by the way, when he's managing this $4 million,
right?
He might this might go to, he might do really well. He's making a $500 a year, right? Okay. And even though 320 is what's owed on this $4 million, but does the trust take that? No, it's just going to accrue over those years, right?
Okay.
It's going to build up because some years are going to be lean, some years are going to be aggressive. It's going to be this ebb and this flow. But yeah, it's naturally we're thinking, oh, this LLC, that means I have to give up. No, you don't give up the 20 because it's got to go back to pay you. Remember where it got it to begin with.
Okay.
I got it here, right? You got it. Does that make sense?
Yes. Now I get it. Yep. Mm-hmm. Thank you.
It does lead into the next question. Well, what happens, Brett, at the end of the 10 years at 6 million, and let's just say 420 has been owed times 10, right? Is that 6 million, 8%? Oh, oops, not 420, 480, right? So end of the 10 years, and let's imagine the trust was making 600,000, okay, times 10, and there's a little bit extra left over, right? So it'd be 6 million here versus 4.8 million. Now, had you not purchased the option, there would be a delta between the two. And this delta would mean as the trustee. Now, this is net of fees, by the way, too. Our goal is to earn 8% compounding net of recurring fees. Recurring fees, generally speaking, are around about 2% on average. And so there could be a delta there. If that delta is there, the trustee's got to be able to get the profit there. I have to have an opportunity to get the profit. Now, you could purchase an option to carve out that upside if you wanted to. There's a way to do that. But that's how we keep the business purpose going, because there's business purpose for me to make a profit at the end of it. But you can also renew it for another 10 years and just keep it going as well. So hopefully I didn't complicate things some, but just wanted to give you that full picture for everybody. So this is a masterpiece. You guys like this? It's
this is better than a Picasso.
We will get better. We will improve every year on that, or every week. We'll keep doing it, right? So we get better on my artistic ability, and maybe Jake gets the artist, and then I do the commentary. So anyone have questions on any of that?
There is a question in the comments, not necessarily on the flow, but on the fees. Maybe we should take a moment and go over that, Brett.
Absolutely. So the fees are, let me share my screen again. Is it a live deal, what we can do, or you want to just do a general fee?
We love making things real.
Okay. Yeah, I know. Does anyone have a live deal they have that you want to go through the fees? No?
So I have a live deal, Brett. This guy has storage units.
Okay.
And he builds them, fills them, and then sells them. Mm-hmm. He currently has one that probably in the next 2 to 3 months, which is perfect timing for us to get into this. In the next 2 to 3 months, it's going to sell for about $5.2 million.
Can we just keep it at 5 to be simple?
We can keep it simple at 5.
Okay.
And by the way, when you step away from the mic, you're quiet.
Sorry.
There you
go away. I
got
to stay close to the mic.
We got 5. You need one of those artists, because we're talking about mixing math with art here, right? you need one of those, what is it called? The little tripod thing where you can have your mouth next to the mic while you draw and paint.
Yeah. Like Bob, what was it? Bob, what was his name? Bob something. He did the little trees and stuff.
That's right. So $5 million.
Yeah.
His adjusted basis is looking to be around 2.8.
Okay. So 2.8 is the basis. Does he have any debt?
No, this will be all debt free. He has an equity partner, so he's not the only owner.
Okay. Keep it simple. Let's imagine he were the only guy, although we can split it up for the people. So what state is he in?
He's in the state of, which state is he in? He's in Louisiana.
Okay. I think that's like a 5%.
I believe 5 is close, yes.
Yeah. Okay. So we're gonna take 5 million, and we're gonna minus that 2.8 million, right? And that's gonna give us the 2.2 million of gain, and we're gonna take 20% federal, 5% state, 3.8 Obamacare tax, plus a couple percentage for depreciation recapture. So we're gonna call it 32%. So they're looking at a just call it $700,000 tax. Okay. Now we always look at this as the fee. That's a fee. I mean, it's a tax, but it's a one-time tax. It's just you're hammered. It's gone.
It's a cost of doing business. Yes.
Yeah, it's a tax. Or we can roll all of the funds into the trust. Okay, all 5 million, and keep an extra 700,000 working for us. So what would the cost be to this? Well, right here it's 1.5% of the first million. So that'd be 15,000 on the first million. Then it'd be 1.25 on anything above, which would be 1.25 on the 4 million remaining. So it's 50,000 there. So it'd be a total of 65,000. That's a one-time legal fee paid at the close of escrow. So they can pay the 700,000 or they pay 65. Okay, there you go.
So again, cost of doing business one way, the normal traditional, and I don't want to be, picking on people who are senior or anything like this, but sometimes you have that really old CPA who just wants you to pay the taxes because they don't want to review something new, right? Yeah. I say that because we've come across that a few times where we've had to work with a client and their accountant who sometimes not everybody's as flexible and as open-minded to doing something that they haven't heard of before or read in a textbook. But here, under this scenario, we definitely have a very compelling story of cost of doing business, $700,000 in taxes, or cost of doing business with Brett and Jake and the attorney, and the attorney is going to charge you 65 grand.
Yep. So that's the start, right? And so we've got an extra 700. You might be wondering, well, what's the government going to charge me on this? This is the cool thing. They charge you 0% interest. As long as what? You don't dip into the 5 million. What does that mean? Well, that means you allow the 5 million just to build and accrue interest. Remember what we said? We like to say the 5 million on average is going to earn 8% net of the recurring fees, net of these fees here, which we're going to talk about here in a second. So the goal would be if they're going to give you an extra 700,000 at 0%, and you can earn an extra 8% on the entire amount. That's pretty cool. That's $400,000, of which on the $700,000 piece of it, that's about an extra $56,000. So within about 1.5 years, you've just paid for the legal fee. You see that? If you look at like that math there. So that's one way to make this thing an investment, not an expense. As well, you didn't have to take $5 million in 1 year, which would shoot you to one of the highest tax brackets. In fact, a lot of our clients will actually just take no interest payments for a couple years, which lowers their overall state income tax. So there's some savings there. Plus, if they do a multifamily investment or a real estate investment, they get a new depreciation schedule if they're active, which they can get depreciation there, which is cool. Remember, in a 1031, the old basis travels, which is not great. Whereas you get a brand new basis with the DST if you're active in purchasing it. Okay, so let's keep going here. So our fees, generally speaking, depending on where and how the funds are invested, would be, we like to say, somewhere around 1.5% to 2% on a recurring basis, just depending on where and how the funds are invested. And then our goal is to say net of fees to earn 8% on 5 million. The details are here. There's a couple other costs. There's tax returns, there's accounting fees, So, but again, net of all those recurring fees, our goal is to get 8%, which means what? We want to earn about 10%. Okay, we're going to earn this, and then this is what you net. Jake, is that pretty good there?
I like it. No, that's kind of the ballpark again. No guarantee, but that is the goal, right?
Yep. And by the way, if you go in or out of network, there's no double charges. Okay. And so, yeah, and again, it's a 10-year time horizon. So it's not a sprint. We don't have to get it all back at once. We want to look at this 10-year, and every 10 years you can renew for 10 years and renew for 10 years. You can pass it to your kids and keep it going. And all this time, this $700,000 is growing as well, right? You would have paid tax on your 0% that you're having to pay the government. There's no interest charge on that, but you get to have, an extra amount per year. It's a win-win-win. So, all right, those are the fees. Anyone else have any other questions right now or comments for Jake or I? It's pretty good. I think the class was pretty good today. I mean, we did a little bit of a detailed mapping out. I want to thank everyone for joining us, and I want to encourage you to come back next week and come back with friends, come back with clients, come back with anybody who wants to escape feeling trapped by capital gains tax. We do have one more other question. For example, you gave to us who manages $4 million. So the money land can be invested and managed by Jake Miller as the financial advisor. And then my role is the trustee. So it's like a team effort here. But you could go back into your own, say real estate or business venture with some of the funds. In fact, up to 80% can go back into other business, active deals. But I would say most of our clients are diversified in a couple different things, and we're all working as a team to do that. So hopefully that answers the question, Lan. Yeah, I think it did. And the funds are held at like TD Ameritrade, Charles Schwab, and they're invested in some of the largest, biggest companies in the world. So, all right. With that being said, I appreciate everyone being with us today. If you want to take action, we encourage you to go to capitalgainstaxsolutions.com or getting with Jake by going to strategictaxsolutions.com and coming back to this mastermind. Look for the new book that is coming out soon, Building a Tax-Deferred Exit Strategy. Jake Miller is the secret man who's in the book. He has one chapter. I have a couple chapters too, and then we have a cool guy named Kevin Harrington from Shark Tank. He's in the book as well. We so appreciate everyone out there. Jake, any parting words before we go?
Have a fantastic weekend. We want you to improve your quality of life, and that's why we're here today, to help you do more with your money so that you can overall increase your net worth and pay less in taxes.
Beautiful. Thanks, Jake. Thanks, everybody. Talk soon.